Welcome back to the Compassionate Capitalist Show. We're going to cover a topic that I've not ever covered before today. And this is about investing in gold and precious metals. And when I had the opportunity to cover this topic, I was decided I needed to find somebody that I could have a conversation with about the gold marketplace or the precious metal marketplace. And what does that mean? And because throughout history, gold has been seen as a special and valuable commodity. And today, owning gold can act as a hedge against inflation or deflation alike, as well as a good portfolio diversifier. As a global asset of value, gold can also provide financial cover and a balance during geopolitical and macroeconomic uncertainty. But how do you invest? Do you just buy gold coins like they're advertised in a parade magazine, or do you buy it on an exchange? Is it worth it buying 3 coins, for $1,000, or is it the kind of thing you need to have $100,000 to invest in order to have any meaningful thing? I mean, what is that, right? And in my company, Cougaran Capital Holdings, I'm always getting the question, oh, is that the gold coin, the Krugeron, right? And it's a nickname that somebody gave me back in the days when I first started IBM, and I was like this mover, shaker, hustler, and my last name being Rands said, oh, Krugeron, you're going to be, my friend named me that. And she said, because you're going to be worth gold, kind of a thing. So I don't spell it like the gold coin. And it's not, but I sort of, what I do is about the money. So, I use that as a visual or connection there. Anyway, so that's a question too. Is gold that you invest in coins, are they all Krugeron? All this and more will be answered today by my guest, Patrick Yip. All right. So sit tight. Y'all are going to have, this is going to be a good conversation. Let me tell you about Patrick. So Patrick serves as the director of business development at APMEX and ONEGOLD. APMEX, APMEX, is one of the largest retailers of physical gold, silver, platinum, and palladium, and has sold over 15 billion in product over its 20-year history. And I'm going to tell you, when I bring him on, I'm going to give you some statistics I heard him tell on another video. So, and ONEGOLD is a fast-growing online precious metals platform that we'll talk about too, that has processed over 750 million transactions during its first 3 years of business. Patrick joined APMEX in 2011 and has held roles in merchandising, sales, product management, business development, and played a key role in the company 250% growth in the marketplaces such as eBay, Amazon, and Walmart. So there you go. Not your Parade magazine, but some of these online places. Walmart, wow, that's where America shops, right? So welcome to the show, Patrick. So glad to have you here.
Hey, thanks for having me on, Karen.
So okay, so I watched that video, right? And you guys were doing like $1 billion in 2019 on APMEX, and then 2 billion, something like that in 21, smashed through that in 2021, and on track in 2022 to do how much? In May, you had or March, you had a huge month. So you're like going to do 4 billion this year or something?
Yeah, we're on track to sell over $2 billion in precious metals. And this is all retail sales. So this is to end users, investors, basically the retail public that's buying precious metals. And that's right. In March, we did have our best month ever in our 20 plus company year history, and we actually sold over 260 million in precious metals. So the demand has definitely been picking up. I think a lot of people see that inflation is in the news, and historically what's happened is precious metals such as gold and silver have served as a nice protection against inflation.
Okay, so the question that I always have to start with is like, so how did you get involved in gold and coming to work for APMEX? I mean, that's not something where you're a wealth manager, stockbroker guy, and then went and then got into like that, or were you in sales and you just got hired? This is always a fascinating story, how people arrive at their career that they obviously are successful at. So
Yeah, that's a great question. So I'm sure you and many of your guests will remember what happened in 2008. But back then, I had a typical portfolio, basically stocks and bonds. And then obviously the financial crisis hit. So my portfolio got chopped in half. I'm sure, unfortunately, a lot of you guys probably had the same experience too. Now that I look back, I kind of joke that my 401k became a 201k. Not really a funny thing to lose that much assets, but I mean, it happened. That's history. I then called my financial advisor and said, "Hey, what happened?" And I recall him saying something like, "No one could have predicted that crash." And I go, "Well, that's kind of interesting." And like I said, I know a lot of you guys probably got burned as well. So that got me looking into Austrian economics. I said, "Okay, so what could we learn from 2008? Like, what did some people not see, and maybe other people saw too?" So it got me looking into precious metals. I became more and more interested in precious metals following that 2008 financial crisis. And in 2011, I was actually shopping online at APMEX. I was actually a customer before I joined here. I would just click their career section and I said, "Hey, that looks like an interesting position." So I interviewed with the company and actually decided to relocate from LA, where I've been since the late 1980s, to Oklahoma City, and now I've been with APMEX for over 11 years.
Very good, very good. Interesting that you mentioned the Austrian economics. That's the one, because I actually have done two interviews with a leading economist in that area out of I think it's University of Alabama, and I was trying to remember his name, but he wrote the book. It's that's the skyscraper theories. Is that in the ballpark? Am I in the ballpark with what you were talking
I
about?
am not familiar with that book, to be honest, but there's a lot of people who study Austrian economics. I think it's definitely the way to look at the economy. I think the opposite is Keynesian, which is basically the Keynesian is where you depend on government to be the intermediary and you want government control. And Austrian is almost like the opposite, where you want more free markets.
Yeah, well, in this particular context, and not to digress too much down that road, but the idea is that when you have monetary markets that make money so cheap, and that people will go and build, they'll put money into building these huge skyscrapers, and because and then eventually though the money can't be repressed, that the value, the money can't be, and that like interest rates and things like that can't stay artificially repressed. You have to have to let there be an ebb and flow, and so
Yep.
inevitably they can track that about a year after the next biggest skyscraper opens up, we have a financial collapse, and they can like
Yep.
date that back 100 years, from the Empire State Building all the way through to the Dubai Tower, which guess when that
Yep.
opened up, right? And so,
Yeah, exactly.
it's like we had a black swan with COVID, but we were going towards that way in 2020 because, in the stuff that we experienced, and then the black swan just of COVID just sort of, accelerated the economic collapse across the world, right? So
Yep.
anyhow, that's that. Anybody, I'll put the link in my show notes, and anybody wants to go listen to those podcasts, because I went back with him and we talked about coming out of the economic lies of 2020, and we talked about some of the things that the markets might do that would have an impact and change it. And I'll send him this one. So anyhow, let's talk about uh the gold and precious marketplace, metals marketplace. How are prices set? How is gold sourced? Is there a limited supply that drives the price? Lay it out for our listeners. Gold investing or precious metals investing 101.
Yeah, so normally precious metals are first they are mined by mining companies. From there, they basically make like what they call doré bars. These are bars that are like, let's say 80% gold, 80% silver. They're then shipped to a refinery. These refineries take these doré bars, refine it into what they call like 999 or 9999, three nines or four nines, basically meaning 99.9% pure or 99.99% pure. Basically, these get turned into like large industrial bars. It's the stuff that you imagine if you watch like a movie and you see these large bars, large gold bars, large silver bars. They get turned into that stuff. From there, what happens is the bars are then flattened out. They're put into these long sheets at a mint, and then the mint stamps it out. They make basically round shaped things, which are called blanks, and or square shaped things called bars. From there, they stamp it out. They put certain things like most countries have or a lot of the bigger countries have a coin. So the US coin is called the American Eagle. The Canadian coin is the Canadian Maple Leaf. Obviously, the South African coin is called the Kruger Rand. You kind of alluded to that earlier. But they basically, these mints make these coins. From there, they get shipped to authorized dealers. So unfortunately, like as a retail public, you can't call the U.S. Mint or the Royal Canadian Mint or the South African Mint and say, "Give me a Kruger Rand." They're going to say, "Well, buy through an authorized dealer." So that's where you have APMEX come into place, and APMEX is our parent company, and we're one of a handful of authorized purchasers from the U.S. Mint. So we buy the coins directly from the U.S. Mint. We make them available to the retail public. And then we basically sell them, and as I mentioned, we're on track to do over 2 billion in sales to retail precious metals customers.
All right. So, okay. So that you know, okay. I'm like, wow, that was really interesting. I'm almost speechless, right? Uh, so I got how it's sourced. Is there a limited supply? I mean, everybody talks about like limited supply of oil. Is there a limited supply of gold? Are they trying to do discovery and dig deeper to find more? Or what we got is what we got, and that's why it continues to go up in value?
Yeah, so I think like any commodity, there is a limit to how much can be pulled out of the ground. The big thing is you could always pull more, but it's just at what price? Like so you hear that people say, well, you could get gold through space. Well, okay, fine, there is gold in space, but what does it cost to send a rocket up there to mine the ore and bring it back to the U.S. or to the Earth? Well, probably more than it's worth. So there's always more gold out there. There's more oil out there. It's just a matter of what cost. Obviously, no one's going to be pulling oil out of the ground if it costs them $200 a barrel if it's selling for $80 a barrel. Same thing with gold. No one's going to pull it out of the ground for well over its cost or well over its market price.
So how is the market price set? Is it just supply and demand, like the way stocks are, or
Yeah, so it's basically exactly like that. Just like any commodity, it is supply and demand, basically number of buyers, number of sellers, and then whatever the market clearing price is, that's what it trades for.
is it the kind of thing that you can predict a trend of it going up or going down like you can with stocks and even with like Bitcoin to a certain degree, people that are in it on a regular basis, they know how to predict and when to sell and when to buy. Is it kind of like that? Can you see trends?
Yeah, so you could see trends definitely. It's just like any stock or commodity. You could chart it. You could look at a lot of this stuff, but I think one of the things to look at too is how gold reacts in inflationary environments and how it's acted in the past. If you want to touch on inflation and what my thoughts on in terms of how it's going to react in the next couple of years, we can get into that.
Yeah, I want to roll with that in a bit, but it's still sort of in the 101 place. And by the
Sure.
way, the website apmex.com, at the top, y'all have like a ticket tape going on what the value is of the different precious metals. And so I thought that was really interesting to look at that and go, oh, okay, so it seems like and so when they price it, is it all by weight or is it a combination of weight and the quality, the 99.9999 whatever percent? So it doesn't really matter where you buy it because it's always going to be the same price because it's based off of a very structured weight sort of thing. There's not a intrinsic value, where a US coin's going to be worth more than another country's coin because people like eagles better than they like this. It's because it's just coin, it's just gold. Is it like that?
Yeah, that's a lot of interesting points to touch on. So the gold and silver are priced on the commodity exchange. So basically the COMEX owned by the Chicago Mercantile Exchange. So it's like the commodity exchange for basically like you have all the different commodities. You have oats, you have wheat, you have oil, and so on like that. It's like the commodity equivalent to like let's say the New York Stock Exchange or the Nasdaq. So commodities trade on a lot of this basically the COMEX and which is owned by the CME. So that's how it's priced. And what the COMEX is, it's basically pricing. Spot gold, so basically gold in a certain format too, so like basically that, like you mentioned, 99.9% fine gold, and what they do have is they have a standard which is called London good delivery. So these are basically bars that are made by certain refineries. They meet a certain standard. So like I can't just make a bar and say, hey, here's gold, because they're going to say, well, who gave you the recognition? I mean, no one knows what it is, as opposed to you have stuff like, let's say you have the Royal Canadian Mint mint something, the US Mint makes something, and obviously these are large credible agencies, so they have that accreditation, that they could have basically a London good delivery bar which meets certain standards, and that's basically how it's priced.
Okay. Okay. All right. So then, now there's, there's talk. I mean, there's stuff that always, happens, and where this might be kind of, well, I'm going to hold on that because I have to ask one more question before we get into inflation and the gold standard and all that kind of stuff. And maybe we'll roll into it with this, but how much gold or silver should an investor hold? To that, my first kind of question, is it worth it to have $1,000 worth of gold, or should you really, if you're going to do it, you need to go big or go or not at all?
Yeah, that's a great question, and we get it all the time too. I think one of the strongest arguments for precious metals is portfolio diversification. So if you talk to a financial planner, they'll likely say, hey, you should have a combination of stocks and bonds. And the thought is, if you want a high return, high volatility, you'd be heavier stocks. If you want a low risk or low return, lower volatility, you'd be heavier bonds. The downside about it this year, both stocks and bonds are down. So unfortunately, didn't do much for you. But if you look at the past 50 years of history, and I like using history because, I don't want to just say, hey, 10%, 20%. Is like, I don't know. It depends really on your situation. So let's see what history tells us.
Okay.
So if you look at the past 50 years, looking at 10-year average return. So this is assuming you hold your portfolio for 10 years. So it normalizes out the 2008s and the 2020s and so on. Like obviously, anything could happen with a portfolio, but I want to look at longer time horizons. It's actually possible to have the return of almost 100% stock portfolio with the volatility of a bond portfolio. And there's actually theories out this about the portfolio theory, efficient portfolio analysis. I don't know if any of the listeners are aware of this, but feel free to Google it. But what it is you have a certain risk, certain return, expected return, and certain volatility with a given asset. And by adding another asset, and the thought is like, let's say you were 100% in the S&P 500. If you added a little bit of bonds to your portfolio, your return would actually go up and your volatility of your portfolio would go down. And for people who are not aware of what volatility is, my thing is basically it's how well can you sleep at night. No one wants that portfolio that's going to go up 50% this year, down 50% next year. You're going to be stressed out all the time. You ideally want it to be relatively flat, relatively stable. So we looked at it, looking at, as I mentioned, the last 50 years of history. Stocks on average, and this is a real return after inflation, have averaged a real return of 7% and a standard deviation of around 5%.
Yeah.
You look at bonds, obviously lower than that, 5%, so lower than the 7% on stocks, and standard deviation of 3%. So obviously lower return, lower standard deviation. If you put 20% into gold, 80% into the S&P, so you basically got rid of your bonds off your portfolio, you could have a return of 6.7% with that gold and S&P portfolio. So 30 basis points or 0.3% less than the 100% stock portfolio, but a 2.7% standard deviation. So much lower standard deviation than the 100% bond portfolio. Obviously, everyone's situation is different. I'm not going to say 20% is the solution for everyone. Obviously, if you're older, getting close to retirement, maybe it's more conservative. If you're younger in your teens or 20s, maybe you want to be more aggressive. But
Okay.
that's just what data shows us is
Yeah.
20% could be a nice allocation.
So really look at what you're investing, and any amount is. So is there anything that triggers gold to drop in value?
Yeah, so gold is largely a function of what interest rates are doing. So we could
Okay.
get in a little bit into that too, and talk about inflation if that works.
Yeah, let's roll into that part of it, because I was going to ask a question. So say, I've got, like, in 2008 and 10, and during that period of time when some of that stuff was going on, or actually 2012, the Great Recession, um, I had a lot of investors that in my angel investor group, that I was trying to encourage them to invest in entrepreneurs so we could, kickstart our economy and get jobs and things like that, which ultimately became the Jobs Act stuff. But they had it just sitting on the sidelines, spread out in all these different savings account to protect it against the collapse of the stock market and all these other kind of things. Is that the kind of thing that they could have, instead of putting in savings and getting 2%, if they put that same amount of money in the gold, it would kind of get, and it would be better, even though it's tied towards the interest rate, it would be better than the volatility of the stock market and better than your savings account, and as stable as your savings account. So within that context, talk about it as this looming inflation that we may be faced with in the next year, or kind of are in the midst of the beginning of it.
Yeah, so I think you and many of your listeners would already know, I mean, inflation is basically running at 8.3% year over year. I think that's the latest CPI stats, which is the highest in over 40 years. So let's look way back. Unfortunately, you have to look before the 1980s because we haven't had an inflationary period since the 1980s. So if I look at the 60s and 70s, let's look at how different asset classes performed. And in the 1960s and 1970s, what you had was an inflationary environment with the Fed raising interest rates, which sounds very similar to where we are today. And obviously, history could repeat, it could not repeat. Who knows? Maybe it'll rhyme. But if you look at the 1960s, first let's look at stocks. So in the 1960s, we had inflation hit as high as 12.3%, so well higher than what we are today. And what do stocks do? Stocks actually lost value on there. So not only did you nominally lose value, you lost value due to inflation as well. And then you look at the 1970s, the S&P actually did slightly better. It was actually flat. It was up 4%, I believe, during that inflationary period. But inflation was even higher at 14%. So stocks may not be the best tool during an inflationary and rising interest rate cycle. And then let's look at gold, for example. If you look at the 1960s, during that inflationary cycle, gold went up fivefold from $35 to $200. And then in the 1970s, it went up from $100 to $850. So basically an eightfold move. So my thought is, I think a lot of things are cyclical. Nothing goes up forever. Nothing goes down forever.
Okay.
So if you look, let's move forward now. Let's get out of the 60s. Let's get out of the 70s. Let's look more towards modern times, because people's like 1960s. I can't relate to that, right? I mean, it seems like a long time ago.
A lot of other moving parts nowadays than it was back then. So
yeah. So let's look a little bit towards modern times. So let's look at 2000 till now. So, like I said, a lot of things are cyclical. You remember, like if you look at the S&P and you could pull up a chart, the S&P had a lost decade from 2000 to 2011. Basically, it didn't do anything. I believe the numbers are, it started at 2000 around 1450, ended at 2011 at around 1250. So it's actually down a little bit. Gold, on the other hand, started at 250 in 2000 and went all the way up to 1900 in 2011 for a sevenfold gain. So gold certainly did well for the first decade of the century. And then let's look from 2011 till now. You had the cycle reverse. So gold struggled. So gold started at 1900, as I mentioned, went down to 1050 in 2015, and now it's back at like 1700. So you look at it, gold's basically done nothing. The S&P, on the other hand, went up fourfold. So 1250 all the way up to 4800 at the beginning of 2022. Obviously, it's a little lower now. I believe it's probably around 3900. But I would say, given that you're in an inflationary cycle, you're in a rising interest rate cycle, if you look at the past, stocks, if history repeats, stocks may struggle while gold may likely perform well.
Okay. So let's talk. We got a few minutes still remaining on our time. Let's talk about the difference between APMEX and ONEGOLD, because ONEGOLD's kind of a different sort of a platform. One, you're buying direct and owning it, and then talk about. I think it's fascinating what you guys have done with ONEGOLD, and that's onegold.com, right?
That's correct. So let's start with the APMEX too. So APMEX is our parent company. It's basically been in business for over 20 years. And what APMEX is, it sells you physical gold, silver, and platinum and palladium, basically bars, rounds, coins, whatever you want to do, for physical delivery. So I almost call it like the Amazon of precious metals. Anything you want is available on APMEX. We do have collectibles too. We have Peanuts coins. We have John Wick bars and so on like that, if you're into a lot of this stuff too. But the nice thing about APMEX is when you take physical possession of metal, you have it in your hand. No one could hack it away. It exists. It's tangible. You could easily pass it from generation to generation. So you have a lot of privacy there. Taxes are self-reported. I do recommend that you do report your taxes, but there's a lot of people that like that benefit. There are a few downsides, obviously, to physical precious metals. The first is they're a little hard to liquidate, because if you have gold in your hand, now you said, well, you need to find someone to buy this if you want to liquidate it. And that usually involves sending it to a coin dealer, sending it back to APMEX or so on. And then one of the biggest downsides I think about physical is everyone who I've mentioned to get into physical, they start with a couple thousand, maybe this becomes tens of thousands, and maybe if you're fortunate enough, it becomes a 6 or 7 figure sum. The downside about that is obviously you don't want a 6 or 7 figure sum in your house. Not the ideal case. So we created a solution called ONEGOLD, and I could get into that too if you want. It's basically a modern solution to own precious metals. So
You said
what
it was
one
kind of like Robinhood or Coinbase?
That's correct. So ONEGOLD is actually my preference. So back in 2018, APMEX partnered with Sprott Asset Management, which is basically an alternative investment manager that has over 22 billion in assets under management to create basically ONEGOLD. It's a modern way to purchase precious metals. As you mentioned, it's like the Robinhood or Coinbase of precious metals because it's so easy to use. What ONEGOLD is, it's an investment platform that allows users to buy, sell, and trade vaulted positions of gold, silver, and platinum stored either in the US, Canada, Switzerland, or the UK. So how it works is ONEGOLD first has agreements with various vaulting companies. So we've partnered with Brinks, we've partnered with Loomis. We then buy these large industrial size bars from the wholesale market. And then we make this metal available to customers for purchase. And then when customers buy it, they own part of this larger bar, which gives them basically a very attractive pricing. So customers could buy gold at 0.8% or 80 basis points over the commodity value, and silver for about 2% over the commodity value. And it's important to note that like a lot of commodities are sold for over the value of the commodity due to processing and distribution and so on. It's just like if you wanted to buy Starbucks coffee, you can't buy a pound of Starbucks coffee for $2. It's just not possible. But that's what coffee is trading for in the commodity market. It has to go through the whole distribution network too. So basically prices are basically some of the best available online. Metals obviously insured and audited. And then if you decide that, hey, you don't want this position too, you could easily sell it, liquidate it. We'll process a wire or ACH that same day. Or you could even turn that metal into physical gold eagles or gold Kruger Rands or gold maple leafs.
Okay. Okay. So if I understood what you said, you can, if you participate in the exchange then of ONEGOLD, you get a better rate than if you were to go out and buy a physical amount of gold itself, because the way the actual buying and selling of the commodity is handled when it's been made into a gold, it's like further down the food chain of distribution, so it's had some of these additional costs associated with that because it's been minted, all that kind of stuff, versus the raw that you would own some portion of on ONEGOLD. Is that
that's exactly correct. So with
good?
ONEGOLD,
I get this gold star.
yeah, there you go. Yeah, so like ONEGOLD, you're taking possession of, let's say, a 400-ounce gold bar, like the gold bars you see in movies and big bank vaults.
Yeah.
From there, obviously, it has to go through. If you wanted a coin, it's going to go to a mint. It's going to be pressed down. It's going to be minted. It's going to be shipped to a dealer, to APMEX. APMEX is going to ship it to you. There's a lot more people involved in it, and obviously, with more people, there's more cost. So it's going to cost you more if you take that physical Kruger Rand as opposed to having gold and ONEGOLD.
Okay. So very good. So this, I have learned a lot, and I am going to go check out ONEGOLD for sure. And really thank you so much for being a guest on the show. Anything else you would like to tell our audience that we haven't had a chance to talk about in the, I guess, a minute we got left?
Yeah, I would definitely recommend that everyone check out precious metals and at least have a portion of your assets to gold. I think if history repeats, gold's likely to do very well in the near future. As I mentioned, I personally use ONEGOLD as a special promotion. We do have a couple coupon codes for you and your listeners too. So there's the first one is gold 50 off. That's GOLD 50 OFF. That's 50% off the premiums on US gold, which is one of our products on ONEGOLD. And the next is silver 50 off. That's SILVER 50 OFF, which is 50% off the premiums for US silver.
And the premium would be your upcharge.
That's correct.
Okay, cool. Well, thank you very much, everybody. Make sure you go out